Did you know that when you deposit $100 in your bank, they can legally lend out $90 of it to someone else? They collect interest on that loan while giving you practically nothing in return. This is completely legal and called fractional reserve banking. This represents just one aspect of how our financial system operates behind the scenes. From your wallet cash to crushing student loans, a hidden world of financial control affects every dollar you earn, connecting your daily transactions to larger economic forces most people never see. Understanding these mechanisms reveals why your personal finances work the way they do. Yet most have no clue how it all functions. Your student loan's secret journey. What if I told you your student loan isn't just sitting in some boring bank vault? It's actually on a wild adventure through the global financial system. That $30,000 you borrowed to pay for your degree? Yeah, it's living a way more exciting life than most of us. Let's rewind to that moment when you signed your loan papers. Remember how relieved you felt? Finally, I can pay my tuition. But here's where things get interesting. That money didn't come from some giant pile of cash your bank had stashed away. The truth is way weirder. When you signed those papers, the bank essentially created most of that money on the spot, like a financial magician pulling dollars from thin air. They didn't have $30,000 reserved just for you. Banking regulations only required them to have a fraction, maybe $3,000, actually sitting in their reserves. This is your first peek behind the financial curtain. Banks don't lend money they have. They create money by making loans. Your student loan literally expanded the amount of money in the economy the moment it was approved. The journey of your loan begins here, but quickly accelerates. Once that newly created money hits your school's bank account, your loan paperwork starts its own adventure. Within weeks, your original lender bundles it together with thousands of other student loans into something called a student loan asset-backed security, or slabs. Think of slabs like a giant financial sandwich. Each layer contains slices of different student loans, some from medical students, some from undergrads, some from law students. These sandwiches get rated based on how likely the students are to pay back their loans. Then they're sold to investors who want a steady stream of income, your monthly payments. Who buys these loan sandwiches? Everyone from pension funds managing teachers' retirement accounts to foreign investors looking for reliable American assets. That means the monthly payment you make might eventually end up in the pocket of a retired teacher in Florida or an investment fund in Japan. Your financial stress is literally funding someone else's financial security. Take Sarah, a recent nursing graduate with $45,000 in loans. Each month she skips meals to make her $400 payment, unaware that her sacrifice is providing steady returns for a pension fund supporting retirees who never have to worry about their next meal. When you make a payment, it doesn't go directly to whoever owns your loan now. It travels through a loan servicer first. They take a cut for managing your account and dealing with your frustrated phone calls about why your balance seems to never go down. After the servicer takes their slice, your money continues flowing through the system. Some goes to the investors who bought those slabs. Some might go to insurance companies that sold protection against defaults. And a portion often goes to banks that provided additional financing to the whole operation. By the time your money reaches its final destination, up to a dozen different companies might have taken their cut. The system is designed to extract maximum value from your debt, not to help you become debt-free quickly. Now let's talk about that interest rate on your loan. That pesky percentage keeping you up at night. That wasn't randomly picked. It's connected to decisions made by people in fancy boardrooms you'll never be invited to. Your interest rate is typically based on the prime rate, or LIBOR plus some extra percentage. These base rates are influenced directly by the Federal Reserve's monetary policy. So when the Fed decides to raise rates to cool down the economy, your student loan payment might increase if you have a variable rate loan. The people making these decisions aren't thinking about how it affects your ability to make rent this month. They're focused on macroeconomic factors, inflation targets, and employment statistics. Your financial struggle is collateral damage in their bigger economic game. That knot in your stomach when you check your loan balance? That's not just about money, it's about power. The stress you feel about your student loans is a direct result of a system designed to generate profits for financial institutions. Every dollar of interest you pay goes into this massive financial machine. Your 10-year repayment plan provides a decade of reliable income for investors. Your struggle to make payments during tough times is merely default risk calculated into complex financial models. Here's something more frustrating. The federal government backs many student loans, meaning if you default, taxpayers cover the loss, not the investors who've been profiting from your payments. It's a sweet deal for them. Heads they win, tails the public loses. Your single student loan, combined with millions of others, has become a foundation of our modern financial system. The total student loan debt in America is over $1.7 trillion. This massive sum has become a financial asset that countless institutions depend on for their bottom line, while the average borrower spends 20 years paying off their undergraduate loans. Your loan connects you directly to Wall Street trading floors where slabs are bought and sold every day. It connects you to central bank decisions about interest rates and monetary policy. It even connects you to global economic policies as international investors buy up American student debt as a safe investment. That $30,000 you borrowed, it's a tiny thread in a massive global financial web. When you make your monthly payment, you're feeding a system that stretches from your bank account to the farthest corners of the global economy. This is why politicians argue so fiercely about student loan forgiveness. It's about what happens to this entire financial ecosystem if the debt suddenly disappeared. Who would lose money? Whose investments would suddenly become worthless? The answers to these questions have multi-billion-dollar implications. The money creation magic trick. Politicians fighting over student loan forgiveness are just the surface battle in a much deeper financial magic show. What if I told you that the $1.7 trillion in student loan debt was created literally out of thin air? Not metaphorically. I mean literally conjured into existence through a banking trick that would make David Copperfield jealous. The whole system operates on an illusion so powerful that most people never question it, even though it shapes every aspect of our financial lives. Remember those childhood piggy banks where you'd save up your allowance? That's how most of us were taught to think about banking. You put money in, it sits there safely, and maybe the bank loans some of it out while paying you a tiny bit of interest. Simple, right? Well, I hate to break it to you, but that mental model is completely outdated. Your modern bank isn't a piggy bank. It's more like a digital money printer with government authorization. What if your bank is printing money every time you deposit $1? This isn't fiction, it's reality. When you deposit $1,000 in your checking account, the bank keeps only a small fraction on hand, maybe just $100, and uses your deposit as the foundation to create new money through loans. Here's the mind-blowing part. When the bank loans out $900 of your deposit, your account still shows $1,000, and now someone else has $900 that didn't exist before. The bank just created $900 of brand new money with a few keystrokes. This is exactly how our banking system is designed to work. It gets even more magical. When the borrower spends that newly created $900, that money eventually gets deposited in another bank. That second bank then creates even more money based on that deposit. Keeping 10% in reserve, they loan out $810. Now there's your original $1,000, plus the $900 from the first loan, plus another $810, all from your initial deposit. This process continues throughout the banking system in what economists call the money multiplier effect. Through this cycle, your original $1,000 deposit could theoretically generate up to $10,000 in new money throughout the economy, like a photocopier for cash that slightly shrinks each copy, but keeps duplicating. This is standard economic doctrine taught in universities and acknowledged by central banks worldwide. The Bank of England published a paper in 2014 stating clearly, whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. The Federal Reserve explains this process too, though in technical language that obscures its simplicity. This system, fractional reserve banking, explains why the total money in circulation dwarfs the physical cash that exists. In the US, physical currency only accounts for about 11% of the total money supply. The other 89% exists only as numbers in computer systems, created largely through lending. When functioning well, this system fuels economic growth. Banks create money to fund businesses, homes, education, and consumption, generating jobs and prosperity. But it's a double-edged sword that can create massive boom and bust cycles. Consider the 2008 financial crisis. Banks became too liberal with their money creation. Powers, especially in housing, They created trillions through mortgage loans, often to people who couldn't afford them. This newly created money flooded housing, driving prices to unsustainable levels. When defaults began, the system reversed. Banks stopped creating money and started demanding repayment, causing a massive contraction in the money supply, resulting in the worst economic crisis since the Great Depression. Almost every financial crisis follows this pattern. Excessive money creation leads to asset bubbles that eventually pop and cause economic devastation. The 2000 dot-com bubble and the 1929 stock market crash were both fueled by excessive bank-created money. Surprisingly few people understand this fundamental reality. A 2017 poll found that only 10% of British MPs correctly understood how money is created. Most politicians, making decisions about our financial system, still think banks simply loan out deposits. Even economics textbooks often describe a version of banking that hasn't existed for decades, portraying banks as financial intermediaries rather than money creators. The implications are profound. Private banks, not just the government, control the money supply. Every loan approval is a decision about how much money should exist in our economy. Banks essentially have a license to create money, one of the most valuable privileges imaginable. It's like having a legal tender printer, except it's electronic. This money creation ability explains why banking is extraordinarily profitable compared to most industries. While most businesses must make or provide something to earn money, banks can create it from nothing, then charge interest on it, an unparalleled business model. It transforms how we should view the national debt. When politicians worry about government borrowing, they rarely mention that much of that money is created by private banks just like any other loan. The government isn't simply spending tax dollars. Often they're spending newly created money that didn't exist until borrowed. This touches just the surface of money creation. Our financial system contains layers of complexity, from central banks to shadow banking to global currency markets. But understanding that banks create money when making loans is essential to comprehending how our economy functions. Central banks, the economy's invisible hand. Those layers of complexity I mentioned? At the very top sits an institution so powerful it can make your savings account worthless or your mortgage unbearable overnight, without asking your permission. Central banks operate like financial gods, creating and destroying economic opportunities with the subtle adjustment of a single interest rate, all while most people are too busy working to notice who's actually controlling their financial fate. Let's talk about the Federal Reserve, the Fed for short. These powerful financial decision makers directly impact whether you can afford a house next year or if your credit card will suddenly cost you hundreds more in interest. Yet most Americans couldn't name a single Fed official besides the chair. This influential group meets 8 times a year in what they call the Federal Open Market Committee. Behind closed doors, they decide one number that sends shockwaves through every aspect of the economy: the federal funds rate. This is the interest rate that banks charge each other for overnight loans. This single number affects everything in your financial life. When the Fed raises this rate by even a quarter of a percentage point, 0.25%, it triggers a domino effect. Here's a concrete example. With a $300,000 mortgage, that tiny 0.25% increase translates to roughly $50 more per month on your payment. Over a 30-year loan, you're paying an extra $18,000. And that's just from one small adjustment. During inflation periods, they might hike rates several times in a row. Credit cards experience these changes even more dramatically. Most cards have variable rates tied directly to the Fed's decisions. A series of Fed rate hikes can push your credit card interest from 18% to 24% in a matter of months. On a $5,000 balance, that means paying $1,200 in annual interest instead of $900. They make these decisions without sending you any personal notification. You simply get stuck with the bill. Central banks do more than adjust interest rates. They create money when the economy faces trouble. During the 2008 financial crisis, the Fed created hundreds of billions of dollars to prevent banks from collapsing. They simply typed numbers into a computer. They have a digital money creation system that makes banks' money creation look minuscule by comparison. In 2020, when the pandemic hit and markets started crashing, the Fed announced unlimited support to financial markets. That announcement alone caused stocks to jump, saving billions in wealth for asset owners. Meanwhile, if you were living paycheck to paycheck, the benefits were minimal. This illustrates an important reality about central banks. Their policies create clear winners and losers. When the Fed cuts interest rates to stimulate the economy, people who own stocks, real estate, or other assets benefit as those assets increase in value. But if you're saving money in a bank account, you might get 0.5% interest, while inflation reduces your purchasing power at 2 to 3% annually. Your financially responsible behavior actually costs you money. Central banks also function as the lender of last resort, the emergency financial system doctor. When banks risk collapse, they can access the Fed's discount window to borrow massive amounts of cash. It's comparable to having someone who will always provide bail money, no questions asked. When was the last time someone offered to bail you out after poor financial decisions? The independence of central banks serves as both strength and controversy. They're designed to be insulated from political pressure to make tough decisions when needed. This creates a democratic paradox. Some of the most consequential economic decisions affecting daily life come from unelected officials who can't be removed by voters. Central banks can dramatically shift direction depending on leadership. In 2018, current Fed Chair Jerome Powell was consistently raising interest rates, making mortgages more expensive and slowing economic growth. Then in 2019, he reversed course and started cutting rates under pressure from Wall Street and the White House, challenging the notion of true political independence. A powerful example of central bank influence occurred in December 2015, when the Fed raised interest rates for the first time in nearly a decade. Within weeks, global stock markets lost trillions in value, with effects reaching China's economy. One meeting created global consequences, all from an institution most people couldn't locate on a Washington, D.C. map. This influence extends globally. When the Fed acts, central banks in Canada, Europe, Japan, and emerging markets often must respond, even when it's inappropriate for their economies. It's like a global orchestra where some musicians must play notes they know are wrong. Central bankers aren't infallible financial wizards. They make significant mistakes. In 2007, Fed Chair Ben Bernanke claimed the subprime mortgage market problems seemed likely to be contained. They weren't. They nearly collapsed the entire global financial system. Yet these institutions retain enormous power despite repeatedly missing major economic turning points. The connection between their boardroom and your wallet is direct and immediate. When the Fed announces policy changes, algorithmic trades execute instantly. Within milliseconds, mortgage rates adjust, bond yields shift, and stock values change. The financial impact on your life is determined before you hear about it on the news. For average Americans, these decisions create real consequences. Home affordability, debt burden, small business loan approval, and retirement account growth or decline. All determined by economists in a room you'll never enter, making decisions based on models and theories that often fail to capture ordinary people's real-world struggles. Quantitative